Paul, I think you're good, bro. Ooh. I'm on? Yep. Hey, everybody. How you doing? Hey, everybody. How you doing? Welcome to Everything Money Channel. It's a gorgeous Tuesday afternoon here in Ohio. It's not really gorgeous outside, but it is Ohio. We get used to this. Our Cleveland Browns lost last night. Oh, Paul, it was a crushing blow to our Cleveland fans. My children were damn near crying.
I don't think it was a crushing blow.
I know, you're right. It was a great game.
It was a great game.
We talk about football a lot because Paul owns another company, Dynasty Owner Fantasy Football. That's kind of wild, Paul. You have a fantasy football company that's successful with thousands of users.
It's on its way to major success, but it's still got a lot of work to do.
Yeah, anyway, so welcome to the show, guys. Thanks as always for following us, jumping on early. We like the comments. We like the likes. You guys are doing great. Welcome again to our 8-pillar analysis. We're talking about stocks today. We just did a real estate video, so stay tuned to the channel. We're going to put that out. There's a deal here in Ohio that I was looking at. So if you're dying for some real estate, my wife just jumped on, and my wife was always looking to buy, Beth. She said, Gio, get your notepad ready. We're going to talk a live stream and talk. My son will probably be on. Husky, you're right. My beard looks extra glorious today. I cut my own hair today. Look at that chop job, and I got it just nice and frothy, crispy for you. So here we go. Paul, how are you? How was your weekend? I'm on fire today. How are you?
It was a good weekend. I ate like crap.
Do tell. What were you into?
I had a whole pizza by myself. I had
Come on.
quesadillas.
You don't do this often.
I had McDonald's. And I had P.F. Chang's yesterday.
But step back. I was telling people in the last episode, look at this frothy chest. You'll see during the show today.
That's probably why my muscles are up, though, because I've been increasing the calories.
I was going to say, he's carb loading here, folks, just for you, just for the viewers of Everything Money Channel. As always, guys, we welcome you in. Make sure you're tickling that like button, that little thumbs up. I see them going right now. Thanks. You guys are doing great. The Patreon is on fire, Paul. We have...
So let's talk about the Patreon here.
Please do.
Guys, personal suggestion, I bought 8pillarstocks.com. Both 8 as a number and 8 as EIGHT, LMNOP. I bought both those. We're making the website version. That'll be done by the end of March. And then we'll create the app. The app will be very simple. It'll be 8 pillars and a bunch of key stats. Viewing the data on the financials through the app is going to be difficult, so that's how we're going to have the website. For everybody who wants this app, you will not be able to get it at the Patreon price the second it comes out. I'm rewarding those who have supported us from day one. Pretty soon, we're going to increase the price of the lowest Patreon to a higher number. When? Probably in the next 3 or 4 weeks. And the reason being is I don't want people cherry picking when they join the Patreon when they don't. I want to reward those who've supported us from day one. So if you want the app at the cheapest price possible and the website at the cheapest price possible, go right now, go today, and pay $8. You can always upgrade to a different version later. There are 3 versions of the Patreon. Now, I will keep in mind this. Every day, Don sends me the stats. Every week, Don sends me the stats on the page. You don't have to pull it up. But the Paul Super Shorts chat has the least amount of people in. And it has triple the number of messages as the next highest. No need. Has triple the number of messages as the next highest group. So we have the least amount of people in it, and we have triple the messages of the next group, which is the general chat. That's how important it is to be active with us. I talk about my investments every day. Mo and I talk about our investments every day. Our process, everyone there is really dedicated. By all means, if you just want access to the app and website, go to the lowest Patreon. I'm fine with that. It's awesome still. Today what I did in the Patreon is I gave a screener of all of the current companies that are located in the United States that have over $100 million market cap that have all 8 check marks to the 8 pillars. I provided that to the Patreon today, to everybody in the Patreon. A lot of them were banks, so they ignored them, but there were a lot of good companies in there, like Intel, I believe was one of them. Was Cisco one of them? I don't remember. But the bottom line is they're in there. So support the Patreon. It helps support Don and Seth. We're making a lot of great stuff. Another announcement. We are now starting this week sometime, every single day, there'll be a 1 o'clock and 7 o'clock video release every single day. Either 1 o'clock will be a live stream or a video release, and 7 o'clock will be my end of day recap or a separate release for a separate stock that we pull out. So we're having more consistent videos. That way you guys know. We did like a surge this weekend to kind of get some videos out there. So thanks for supporting us who did, and that's that.
Kurt is asking, is becoming a patron worth it for people who don't invest in U.S. stocks? What would you say for that?
If you still want to learn, I think it's still going to be worth it because you're going to get this data. You're going to get a lot of the data I have from White Charts. I'm buying my data directly from the people who White Charts buys from, and I'm going to put it in financials for you. Oh, actually, you know what? You might be right. It's not worth it for you if you buy foreign because you're going to. I wouldn't say that. Is $8 a month worth it to you to talk to other people about your investment ideas? That's what you have to ask yourself.
We definitely have tons of foreign people outside the United States, of course, which is the same definition on the Patreon. But what I mean to say is I think
So it's definitely worth it because you're still going to be able to be
Paul, the
around
process.
like-minded
I was gonna
people.
say, you're learning the process.
For sure.
Yeah.
You join the smallest Patreon. It's fine.
Yeah, we're really trying to teach you guys the process of looking at companies, no matter where they're at, and that process usually has nothing to do with the stock price until the end. You see where it's at. So, with that said, Paul, we previewed the show with looking at Simon Property Group. Would you like to fire that up? As the announcement's over, let's get after it here.
So Simon Property Group, guys, is a mall owner and operator. So I want to sit there and describe it right here. They currently own 207 properties, 106 traditional malls, 69 premium outlets, and 14 Mills centers. I have no idea what that is. It's a combination of traditional mall, outlet center, and big box retailer. All right, so malls have been struggling lately. I went to the mall this weekend. Did you go to the mall this weekend?
No, I had a wedding
It
this weekend.
was dead.
Dead.
It looked like a regular weekend on a regular July afternoon.
Oh, that's right. It's December. That's where you're going with this. Usually, it should just be jam-packed.
I mean,
no
jam-packed.
parking.
I mean, 18 is like wall-to-wall cars during the winter, during Christmas time.
Yes.
It was dead.
What were you doing there?
Mikey was dropping off his computer over at Apple Store to get fixed, and we went and bought some gifts for some family members. And
Some lingerie for yourself, I assume?
Yeah, I don't buy those in public. I do that online.
Keep going, Paul.
So malls are going to be hurt. Internet sales are going to keep creeping up and increasing over time. When I left college, internet as a percentage of all retail sales was like 1.5%. It's now over 15%. So you've got to remember that malls are going to transition. Now, usually people overreact to news. Will malls go away completely? I doubt that. Will they find other uses for mall? Absolutely. Look at there's a couple malls locally that were bought that are dead malls. Amazon went and leased them, and they're now being used as Amazon fulfillment centers. They will have other uses. The question is, do you think malls in general are going to do very well? Now, the one thing I do like about SPG, they only have 207 properties. That's only 4 per state. That's not a lot. I don't think that's a ton. Like I expected to see like 1,000 properties in here. So it's not a lot. We're also going to look at their debt levels and figure things out like that. But we're trying to look at mall operator and say, are they being punished too much for what's going on? That is the question we have to look at. They also own a piece over the past. So one of the things I want to point out here, actually, Simon's portfolio averaged $693 in sales per square foot per year in the last year. This is a very good stat. You know why? You're going to want to go look at their 10K and figure out what that's been over the last 10 years. See how that's changed over the last 10 years. Is that going up? Was it 750 5 years ago? Now it's 693. Was it 1,000? You want to figure out these things as part of your investigation into the company. And we might actually pull up the 10K here and look and see if we can find that information.
Mason's actually asking, does grocery stores account for a percentage of that, or versus the online versus in person? Is it?
No, I don't think so.
Okay.
That's a good question, Mason. And by the way, Mason, please stop trolling me in all your comments because they're really useless, and I'm going to ban you soon. But no, it's by the way, Mason's a good friend of mine. And by the way, I bought him something at the store this weekend. I took a picture of something.
How
This
nice.
really awful quarter zip. And Mason said, "Oh, buy me one." So I got it for him, and it's still sitting in my car, Mason. So you have to come pick it up at some point.
Isn't that cute, by the way? Isn't that cute?
Adorable.
David, a lot of our patrons are on right now. David saying markets are rallying right now, just FYI. Trader Mo is on there answering your questions alongside us. We love having him as a friend and consigliere. So, Paul, keep going. Do you want to start getting through the pillars on this puppy?
All right, guys, let's start. So first off, let's look at the market cap. It's about a $30 billion company. So if you want to buy all the shares, you have to pay about $30 billion to own all the shares of the company. PE, 20.3. It's technically an X, very close to 20.
Very close.
But we also have to wonder, in my head, I immediately go, well, how much of that is a drop in revenue over the last 12 months? Because I'm sure they've lost a lot of revenue over the last 12 months because of stores going out of business or them saying, hey, we can't pay our bills, can we extend, et cetera. So 20 is an X. Now, profit margin, 13.84. That's the last quarter. Not bad. If you actually look at the last trailing 12 months, it's actually 27% on the profit margin. So definite check there. And their gross profit is almost 80%. Definite, there's no check there for that one, but it's a good gross margin. So far we have one X and one check. Still not bad. Now, the other thing I want to keep in mind here, the difference with real estate is real estate has an expense called depreciation. What that is let's say you buy a building. The government lets you take, let's say you pay $1 million for a building. The government lets you take roughly $30,000 a year as an expense on that building for what's called depreciation. You don't actually pay the $30,000. They let you write it off the $1 million of that building's value every single year. So the depreciation is an expense, and it's counted against your profit, even though it's not cash out of your pocket. So we're going to look at this cash flow as being important as part of it, and we're also going to look at the net income and look at depreciation. And by the way, big dividend, 6%. Last year, in the last 12 months, it was 7.6, so it's lowered, but it's still a healthy dividend of 6%.
We thank everyone for your comments. Paul, they're saying there was a little doubling up on your voice there with the mic, and I think we tried to fix it, guys. So let us know if Paul's mic is still a little echoey. And Paul, keep going. Let's get on to revenue growth.
Yep, revenue growth.
Revenue growth is pillar number 3, revenue growth over the past 5 years, Paul.
All right, 3.5 to 5.4. Check.
Whoop, I hit the wrong sound effect, Paul. I gave the wah, wah, wah.
Well, it is a check, but there is a big thing here. Look at this.
Uh-oh, okay.
There's a big jump here. Something tells me there was an acquisition at this point. Because I have a hard time believing that this big mall operator who owned a lot of properties all of a sudden had their revenue on long-term leases jump up 40%. I doubt that very much. So there was probably some acquisition that happened here. So over the last few years, as you can tell, very moderate growth, but it's still a check mark nonetheless.
Pillar number 4 is profit growth over the past 5 years, Paul. Profit growth?
Yeah.
What were you going to say?
I was going to make a joke and say, irregardless, it still had growth.
Okay, go on.
All right, 1.828, 2.1, check mark. Now, in a previous video, I started to show a thing called operating income. Now, the operating income will show you how the company itself did from its own operations. It's before interest and taxes, but it's after depreciation. This is a good way to see how the business itself is going, because now you don't have to worry about taxes or interest payments. If a company has very little debt or very high debt, it's not going to affect, it shows you how the company itself is doing.
RJ, I see your question there. We want PE under 20, and it was just above. Great question.
Just above.
Yep.
What did he ask?
He just said, why was PE an X? And because it looked like 20, it was 20.3, but
gotcha.
Semantics.
Now, operating income here, guys, if you look at it, it is growing pretty nicely. Now, they did make an acquisition. Wait, please tell me this isn't quarterly. I'm going to shoot someone. Nope, it's not. Good.
Paul, tell the folks real quick one more time. This is sort of new. Why are you looking at operating expense?
Operating income.
Operating income. Go ahead.
Operating income is a way for us to look at the company without any debt and without paying taxes. Debt and taxes are based on where you operate, and debt's based on what you choose to happen. So it doesn't really show, if Seth and I both have a business, the exact same business, exact same market, we both do $10 in profit, operating profit, but I have a ton of debt and he has 0. He lives in Texas, I live in California. We're gonna have very different bottom lines, and it'll make it look like that I'm doing worse than he is, even though as a company itself in operations, I'm doing better.
A Bitler asks, why are we using PE ratio for a REIT, Paul?
So that's a great question. And that's why we talked about the whole depreciation aspect. We want to look at this business, and I'll get to that in a few seconds. There's still depreciation in there, but we want to be willing to pay a higher multiple of PE because of that. I don't want to get too much in the specifics of it, but real estate has that depreciation expense, which will show you less profit than you're actually getting. But on the balance sheet, it shows your properties as worth less on the balance sheet than they actually are.
Daniel asks that he has this stock at around 5.5% of his portfolio. Is this too much? Daniel, there's so many variables along with that. If you have a gajillion dollars, if you not have a gajillion, how young you want to be, how aggressive you want to be. Daniel, is Daniel Grass, Paul, Don, is Daniel Grass a patron? If you are not, you can ask all these questions. Is he?
I think he is. I think he is one.
Okay, maybe so. So yeah, we can certainly discuss that on the Patreon page as where you're headed.
All right, shares outstanding.
Keep going, Paul. Pillar number 5 is number of shares outstanding. Paul, I haven't said it quite yet. Make sure we're tickling that thumbs up button there right below, right around. Let's see, right somewhere in here area. Make sure you're tickling that thumbs up. As always, if you're new to us, make sure you subscribe. We put out, so many videos a day. Look at your screen behind me, Paul. This is funny. I was on there. We put out so many videos a day, guys. Every single day we're putting out a video. And on two videos a day, Paul? I mean, it's a lot of content. So you're going to get bombarded with a lot of fresh, daily, new content. We don't double up on anything, Paul. It's all fresh and amazing. Paul goes live.
We might talk about the same stock if something happens in the news or something like that, but it's a new take on it.
New take on everything. So yeah, make sure you guys are smashing that like. We love you. Keep
Number
going,
of shares outstanding and decreasing, 310 million down to 308. Check mark there.
Please have Paul look at how many shares are institutionally owned. I'm curious of his opinion. Chris said that.
We'll look at that later.
Okay, go ahead.
All right, so total current assets, $2.5 billion. Total current liabilities, $3.3 billion. So that's an X there, guys. I don't like that very much, especially, but I imagine probably in this economy with them, it's probably pretty likely. I mean, look at their cash position.
Oh, Chris said this stock is almost 90% institutionally owned.
So what that means, guys, is so many people own it. This is why smaller stocks do better when they're often ignored. A company like this has institutional buying, so it's hard for it to like really jump up in price, to get a lot of volume in there to jump up in price. A lot of people care about that. I really don't. To me, I care about the value and what I'm getting. I don't really care if it's institutionally owned or not. It doesn't matter to me.
Chris, we appreciate the comment, though. Pillar number 6 is current assets greater than current liabilities, Paul.
X.
Did X?
Yep.
Sorry, I just did that. My apologies.
Bro.
Pillar number 7 is free cash flow growth.
Okay. So we're going to look at last year as the most recent year, even though this year a lot's happened. So let's first look at the year-to-year basis, and then from there, we'll go do the last 12 months. So year-to-year. Ready, Seth?
Almost ready. Go ahead, Paul.
Okay, 2, 2.5, 2.8, 3, 2.9.
This is
check mark.
Millions or billions?
Billions.
Billions. This is free cash flow, and the average of all that over 5 years is 2.6, Paul.
Okay, now, I am fine with 20 billion times 20 here because of depreciation. That's $52 billion. And it's actually 30 billion. So it seems like it's check marks from the financial aspect. Now, remember also, it was a 6% dividend on 30 billion. That is $1.8 billion. That's a big chunk of their free cash flow, guys. The good news is, in most property companies, that's what they do to pay investors back. They pay the big dividend. So I'm okay with this dividend being such a big chunk of their free cash flow. I'm actually fine with that. And from a financial perspective, it is only selling for, currently, what was the average? 2.6. So it's selling for about 12 times free cash flow. Okay. So if you guys see, the PE was 20 and the free cash flow multiple was about 12. And that's with increasing free cash flow lately. So one of our users before he got off said, malls suck. Guys, are malls in general going to do better or worse over the next 10, 20, 30 years? I think they're going to do worse. But
this isn't is this a cyclical thing, Paul?
Well, it's not a cyclical thing. We're having a secular change in the way people buy right now. With that said, there are other companies who are doing great jobs where there'll be other opportunities. I don't think people are going to stop going to malls. It's still a place to interact. Women love going there. I like going to the mall. It's still a fun place to go. Now, the question you have to ask yourself is, so one of the things I want to look at is EBITDA. EBITDA on real estate is very important. It's right here. What this means is
expenses before income and taxes.
Hang on a second. Let's look at the free cash flow for the last 12 months.
Expenses before income and taxes, Paul? Are you surprised I know what EBIT?
Earnings before income, taxes, and depreciation and amortization.
Darn it. Okay, I was close there.
In the last year, the last 12 months, they've had free cash flow still. It's been about 1.7 billion. So it's down a lot, but they still have free cash flow, which is great. You want to see that. Let's see from the quarterly basis how it did. Guys, only 1 quarter of negative free cash flow. Wow. And that was June 2020, which makes sense. Holy cow, that's impressive. Guys, Simon Property Group, I don't think they have, so here's the deal. In real estate, what you want to do is you want to pay a multiple of EBITDA, okay? EBITDA is earnings before interest, taxes, depreciation, amortization, okay? So let's go to the last 12 months. This is going to be a skewed number. Their EBITDA over the last 12 months was $3.7 billion. Okay, there's a thing called a cap rate. What a cap rate is how much return you get if you pay cash for the property. The higher the cap rate, the lower the price, right? So if a property makes $1 a year and you pay a 10% cap rate, you need to pay $10 for it because $1 divided by 10 is 10%, okay? If you want a 5% cap rate, you pay $20 for it because $1 out of 20 is 5%. So the lower the cap rate, the higher the price. Now, let's say malls suck. All malls tend to sell for very low cap rates because they're premier properties, they're beautiful. What I like about this company is they're currently selling for $30 billion. Well, you take the debt out of them. So now we have to go back to now we have to sit there and say, okay, let's take all their, I'm going to skip a couple steps here, guys. Enterprise value. Their enterprise value, that is the value of their company adding the debt back in, is currently $53 billion. Their EBITDA is 3.7. You're probably like, what the heck is this guy talking about? So if I want to buy the real estate all in cash, to pay $53 billion for it. Seth, what's 3.7 divided by 53?
0.069.
So 7% cap rate. So right now, this big mall property is selling, their business is selling for about a 7% cap rate. I'm actually surprised it's that high. And not only that, that's based on last year, the last 12 months, terrible profit, because they had a quarter in which they had like no revenue coming in. In previous years, they were as high as $5 billion, guys. $5 billion divided by 53 is 9, what is that, Seth? 5 divided by 53?
Sorry, my friend. I'm watching these ridiculous
Call it
comments.
9%.
Oh, yeah, it is. It is 9.4%, Paul.
9.4, even better. So, guys, I would say this. My opinion on SPG is, if you think SPG is a mall operator who will continue to make their properties the better, or at least keep them stable, I don't think you're going to do bad. Because remember, interest rates right now are super low. They can still borrow money on very low interest rates. They don't have a lot of debt in their properties either. Their properties are worth $53 billion in terms of, the company's worth $53 billion, and their debt is a total of $30 billion. See, that pretty low number in terms of long-term liabilities is $26 billion. It's about half the debt number. I mean, you have to, this is part of the qualitative part of investing. As a real estate buyer, you have to decide, are you going to buy this company? Do you think, if they're a mall operator, is this mall operator going to do it? So, let's go a little bit further on this one. Do we want to go further, Seth? Or do we want to go to a different stock?
This is pretty deep analysis, I would say. We do have some stocks off our Patreon request line that we can start looking at, Paul.
Okay, let's do that. But one thing I want you guys to do is...
Hey, what is your final take on SPG?
Somebody look up for me. They said they do $693 per square foot in sales every year for the last 12 months. Somebody find out what it was in years past for me. What was it in 2010? What was it in 2005? What was it in 2015? Revenue for their stores per year per square foot. That'll be an interesting thing to find out. But remember, this is still a company that's going to generate cash flow for the next 10, 15 years. Just because it's decreasing doesn't mean you don't pay it. In fact, it's been increasing lately. So don't get yourself thought and thinking, malls suck, I'm never going to buy them. No, malls are not going to do well, but I can still factor that in over the next 10, 15 years to determine how they're going to do and how I can make money.
We welcome in a lot of people. Jonathan, I see you there, living alone. Thanks for the questions. As always, Benjamin and David. Trader Mo is in there answering some of your questions. Cameron, good to see you. A Bitler and Layla, welcome. We have a lot of stocks off our Patreon line. A lot of these questions, guys. Paul, people are asking about your CCL, some off-topic things. If you join our Patreon, you can ask Paul anything you want, and you can get in our group of like-minded people who are all talking about the same stuff that we believe in, sort of a more disciplined approach to investing. If you join the Patreon, you can ask any question you want. But moving forward, Paul, we have a couple off the request line. Husky, a dear friend of ours. Husky, one of the patrons, asked for Kimco Realty Corporation. You want to look up KIM?
Oh, so we're doing another...
I think so, Paul.
Okay.
It fell in line. The reason I like this one next after SPG was it fell in line with what the topic was.
Shopping centers. Okay, another shopping one. They own a lot more, 400 of them, 59 million square feet. So the only problem with doing this one though, Don, is look how long the SPG one did. So that's the only thing. Like on this one, let's look at some key financials.
Okay, go ahead.
Annual. They sold some things off. Free cash flow.
I think the interest in these malls are people are talking about them. I mean, there's some differing opinions on what people are saying, Paul. So we have tons of other holdings groups and requests if you want to keep going.
Yeah, let's not do another real estate. The real estate ones, I want you guys to remember. SPG is a well-known good real estate business. Go watch this video over and over again to see how I looked at numbers and compare it to other real estate businesses. They take more thorough analysis because depreciation also affects the book value on the books. So let's say, for example, you buy a property for $100. 30 years from now, it's valued $0 on the books, but it very well could be worth $300. That's where you can make some money on your financials because you depreciated it all the way to $0 on your books, but it might be worth 300 in real life. That's where the financial statements on these real estate companies get a little confusing, but a guy like me who knows real estate and knows real estate understands what's behind that. That's something I want to talk about more in depth as you guys do more research about these companies.
One of our patrons asked for Tattooed Chef, Paul. Have you heard of Tattooed Chef?
Tattooed Chef?
Yeah, it's TTCF. They do massive upside plant-based foods. Pretty interesting company.
No revenue, pass.
Just like that.
There's zero revenue. What am I going to do? Guys, remember, I want you guys to bring me companies that have been around for at least 5 years, have revenue, and have profit. That is kind of we need to look at those because right now, this is a totally different analysis. There is zero revenue here. Like, look at this, like literally zero revenue. Did this just go public or something? Maybe it just went public. I don't even have the information.
Okay, you don't even give these companies the time of day, whether they're...
Why should I? So here's the reason why. I don't give them time of day because let them make their mistakes. Let everybody else hype them up. I'll wait till the dust all settles and I'll say, okay, which are the good ones for me to buy? Because the average person to go up there and just go, look at the stock going up and buy. Then all of a sudden when they don't go up anymore, it's going to crash. Okay, then there's a more stable company. Let me go analyze that company. That's just the way I like to do things.
How about Spark Energy Drink, SPKE? People are drinking this stuff, Paul.
I've never even heard of it.
You're not into these energy drinks, are you?
I'm not. You know what I do like though?
Go on.
What was the one? Who makes LaCroix?
I don't know, but you like that stuff?
No, I hate LaCroix.
Oh, go
but
on.
people love it. It's like Fizz. I think their ticker symbol is Fizz. Is it Fizz? Yeah, National Beverage Corp.
Okay, you want to look at it?
What are they at? $81. F.
What's the price matter though, Paul?
Well, because it was at freaking 60 when I wanted to buy it. Not even 60, maybe 40. Yeah, it was 40 something. Anyways, but this is a good company from back in the day. Let's look at Fizz. So Fizz makes LaCroix. Okay. And they make another energy drink. Rip It energy drinks, Everfresh juices, Shasta and Faygo, and LaCroix.
Oh, Faygo, Paul.
Faygo. So, $3.8 billion company. Okay, you buy all the shares out. PE ratio, X, 23. Okay, so it's selling high. This has happened. It was selling a lot lower before, of course. But look at this profit margin in the quarter, 17% with a 40% gross margin. So check mark here, X here. No dividend, all right? But the whole point is we're looking at this stuff right now, getting a high-level view of what's going on. In the last, yeah, that's that. So let's go to the next thing, revenue growth. Okay. I imagine the revenue growth here is pretty solid.
Pillar number 3 is revenue growth over the past 5 years, Paul.
705 to $1 billion on the nose. Yeah! Okay? That's a pretty impressive feat. That is 300 over 700 equals like a 43% growth in the last 5 years. Okay? That's pretty awesome. So this company is definitely growing.
Paul, I would have a sit-down conversation with Mason because he puts comments. I have no idea if they're completely ridiculous and joking or if he's trying to trick me or if I should actually read them.
What did Mason say?
I don't even know, but like every time he puts something up, I'm like, is this a joke?
Mason is joking 85%, 95% of the time.
I'll just skip it then. Let's keep going. Love you, Mason. I'll see you in basketball. Paul, let's do profit growth over the past 5 years. Pillar number 4.
61 million to 130.
Wow,
definite check there. But they're down from the last 2 years. Look at this, 150 to 140 to 130. So they are down. So but this came in the first quarter of the year where I'm sure things suffered, etc.
Okay, how about pillar number 5, number of shares outstanding? We want this going down.
Oh my God, very marginally up. 46.45 to 46.63. It's still an X, but barely an X.
Okay.
What's he laughing at?
He said, Mason said, I'll start putting an asterisk on my serious questions. Thank you, Mason. I appreciate that because Paul's not seeing them.
Don't believe him. He'll probably put an asterisk on everything and he'll be like, hey, what color was your poop this morning?
Pillar number 6 is current assets greater than current liabilities, Paul.
Current assets, $565 million. That's pretty much the cash on hand. Mm-hmm. Current liabilities, $140 million.
That's pretty good.
Well, here's the better part.
Ooh.
Total liabilities, $193. So what was it, $563 million?
Yes.
565 minus 193, so $375 million extra. So when we were paying, the market cap of the company was
this is FIZZ.
3.7.
This is FIZZ we're looking at.
Now it's basically 3.4 billion. So it decreased by 10%, $3.4 billion market cap. The PE was 24, goes down to 21.8, still a check. But the point is, what you're doing here now is you're buying the company and it has enough cash to pay off all the company's debts and have cash left over. So you're essentially paying that difference less for the company. You're buying it for 3.7, but you're getting a net $350 million at closing. So you're basically buying it for 3.4 billion. Does that make sense?
How about pillar number 7, free cash flow growth?
Free cash flow growth. Free cash flow growth. All right, ready?
I'm ready.
Well, not for you yet. It's 68 million to 155 million.
That's pretty good, eh?
Check mark for sure. So 68, 100, 123, 10, 100, and 155.
Average is 109. That is the free cash flow, FCF, average per year. 109 million? 109 gajillion? What is it?
109 million.
Okay, keep going.
Times 20, 2.2 billion. So it's still selling for too much, guys. However,
What's the original market cap? I'm sorry, Paul.
What?
What's the original market cap of this company?
3.7, less than 300 million.
Thank you.
3.4, call it 3.5. So here's the deal though, guys. The question is 20 a good multiplier? This thing's gone up 2.5 times in free cash flow in the last 5 years. You have to go do your research. They only have $1 billion in revenue in the last year. You have to find out, can they grow that even faster? It seems like it was all organic growth too, because it wasn't big jumps. It was very consistent, 9, 10%. I'm still probably buying it for a third less than what it is today. So if it's $81 today, call it 55 to 60 bucks is what I think it's worth. You know me, I want to buy things for much less than I think they're worth. Because right now it's selling for about 33 times free cash flow right now. That's a big premium to me for a company that's not growing by 20, 30% a year. But I like this because LaCroix is a very popular brand. You either love it or hate it. A lot of people in our office love it. I hate it. I always said LaCroix, more like La Crap. Thank you, Nate. You like it? Oh, Nate doesn't like it either. Do you like it?
I hit the crickets on that joke. So,
What's better, LaCroix or that joke?
Paul, folks, listen, we love you. We love that you guys are smashing like. We love all the viewers out there. You guys are incredible. All the comments are incredible. Paul, the comments are all over the place. And so I'm trying to keep the show on the rails, everybody. It's proving to be difficult because everyone's all over. Apparently, there's some CCL questions coming through. People want to know about REITs. Bullet says, how about KBWY REIT ETF? Safer and better yield, low PE, good balance sheet. I mean, do you want to look at that one? Maybe see what he's talking about?
Well, it's an ETF. And so, the ETF sector, we just want everybody in the ETFs. Guys, if you believe in an ETF, go look at the ETF. If you believe in the sector, go look at the sector. We're here to talk about individual companies mostly. Because the ETF has tons of companies in it.
Yeah, that's true. That's true.
Should we go back to the Spark one? What was the Spark one?
Thanks, Don. Yeah, Spark is this next one.
Okay, so let's go to Spark. Now, this is a smaller company. Oh, boy.
Social Dancers from Toronto says, how often do you reanalyze the 8 pillars of companies in your portfolio? Every quarter, every year? No, I think more often than that, Paul.
Yeah, I mean, I'm always looking for, whenever more information, new information comes out, I do some looking. Because remember, I'm always trying to sell puts and calls. So I always have to look at it and say, okay, has anything changed? Does anything make me want to change my number a little bit, et cetera? So I look at them. That's why I don't hold 100 companies. I want to hold, 25 or 50 companies. Currently, I hold like 7 companies. So it's always enough manageable companies. Now, granted, it also depends on, am I buying a $300 million company or a $30 billion company? The bigger the company, the less work I have to do because it's less likely to go to zero. This company is more likely to go to zero than a $30 billion company. So these are you have to look at. So $340 million market cap, 8.4 PE, check mark, very low right now. Now profit margins in X, it's only 7%.
We want that to be 10.
Yep, and the gross margin's about the same way it was for LaCroix, about 40%.
Are you seeing that dividend, Paul?
Oh my Lord, I didn't even notice that.
Look at this thing.
Wow. Call it 8% to be easy. Times 340 is, call it $25 million dividend per year. So
Paul's doing that calculation. Go ahead, Paul. Why are you doing that calculation?
$25 million dividend yield. Dividend yield 7.75%. They're going to spend about $25 million a year on dividends. So we want to make sure their free cash flow can easily support that $25 million dividend. I've told Seth before, this could be a trap. They could be doing this to get you to buy the stock because somebody else is going to look at this going, oh my God, if I just hold the stock, I'm going to get 7.75. They do that on purpose sometimes. So we're going to look at this in a little bit.
How about revenue growth over the past 5 years? Pillar number 3.
I would
Paul?
love to show you revenue growth over the last 5 years.
Make sure you guys are smashing like. The comments are rolling in. Paul, people are saying Tesla's joining the S&P this week.
Yeah, Friday.
People want to know about your CCL position. Guys, most of these questions can be addressed if you want to join our Patreon. For a small monthly fee, you get a community of people who are learning from Paul, and most of these questions get answered, including the Paul and Seth Trader Mo uncensored videos that we do, live streams with our Patreon only. All the Patreons, we get together and do videos just for you. We released one just a couple days ago, Paul, about my portfolio, where I release all my numbers right in front of you. And people are asking about your portfolio, Paul, and you'll see all of that in the Patreon if you want to join. So keep going, Paul.
All right, guys. So there was a check mark here. They went from 357 million to 811 million. But
Go
look
on.
what they did in 2018.
Ruh-roh.
So they dropped 20%. Now, they could have sold the division. What the heck? Oh, they could have sold the division. A lot of things could have happened that caused it to happen. This is part of your due diligence. You have to figure out why they went from 356, 547, 800, a billion, 811. So that's something to look at. Now, before we go further, let's look at their trailing 12 months.
Is that a Rolex Submariner black dial with a Jubilee bracelet on your wrist there, Paul?
Is that Vinny?
Nope, somebody else.
It is the Batman. It's the black and blue dial. It's called the Batman.
Husky ask, of course. And my 7-year-old is now on the stream as well. So welcome.
What's up, Hank?
Welcome, Hank Kirchanen. Husky was very close on that one.
Guys, look at their revenue in the last 12 months is down to $622 million.
Up from
What
$1 billion.
has happened?
Go on, tell us.
They're not up. Yeah, up from 356.
Down from
but
$1
down
billion.
from $1 billion.
Yeah, sorry about that.
But down from $1 billion. Okay, let's go look at their annual profit growth.
Please do, Paul.
Oh boy. 3.9 to 8.5. It's a check mark.
But
There's some movement here. All right, we got to figure this out. Somebody find out why their revenue and profit is down so much. Oh boy, shares outstanding.
pillar number 5 is number of shares. We want this going
6
down.
to 14.
Holy
X.
cow, Paul. We have not seen that much sell-off.
That's a big jump.
Why are they doing that? Tell the folks.
There could be a million reasons why they're doing that. They could make acquisition there where they jump the shares. They give shares to some companies saying, hey, we'll buy you and we'll give you our shares instead.
How do stockholders feel about this when you maybe you're an OG stockholder, next thing you know, your stock's worth less than half of what you originally bought it for?
Oh, they dilute you. Yeah, it
Yeah.
should bother you. As an investor, it should bother you. It's just, one of the things we're raising money for Dynasty Owner, and the one thing we're telling everybody is if we go raise more shares, apart from us getting a legitimately good reason that is a very good benefit to everybody, we're not going to issue more shares. We're just going to sell our shares out. We're not going to sell their shares out. Okay, total current assets 198 million, 197 million. Total current liabilities 83 million. Total liabilities 184. So this is the big check mark here. They have about $12 million more than they do in total liabilities, and they can definitely cover their current liabilities as well. So that's a big check mark there, which is great. It's hard to go broke when you have plenty of cash on hand.
Pillar number 7 is free cash flow growth, Paul. Cash from operations minus capital expenditures. Layla, I see you asking there about Patreon. A lot of these people who are commenting right now are in the Patreon, so they'll answer your questions. Love you.
44 to 84, check mark there. You ready, Seth?
I'm ready, Paul.
44, 64.7,
Keep going.
60.4,
Yeah.
58.3, and 84.
84, okay.
Average.
62.
I mean, this is selling for 5 times. I mean, guys,
Why do you chuckle? What's going on?
$340 million company, it's averaging 62. That's 5 times free cash flow.
Uh-oh.
I mean, that's so low. Now, let's go look at, we got to understand, this is weird. Why is it so low? We got to go look at their last 12 months.
Spark energy drink. Interesting, Paul.
Man, their last 12 months have been really, guys, I'm really confused. Their free cash flow in the last 12 months was $97 million, which is 3.5 times free cash flow. And yet their income is down a ton. Look at their quarterly income. Something must have happened. They must have sold off divisions or something. I don't know. We can look at it. So, I mean, look at their revenue here. Last quarter was 141 million. The same quarter previous year was 207 million. The same quarter the previous year of that was 258. So they went from 258 to 208 to 141 in revenue quarter to quarter to quarter.
Yikes.
Yeah, that's a big, by year. This was 2008, so Q3 2018, Q3 2019, Q3 2020. So guys, this is part of what I like about teaching. It's like, you're not going to do these things on your own, but I want you to remember, like, this is weird to me. I have to understand, why is their revenue down almost in half in a 2-year period? That is something very, very important to understand here. And their shares went from 6 million to 14 million in a matter of 5 years. I mean, that's crazy. I mean, listen, the free cash flow number is insane. Their free cash flow, they're selling for 340 million. And the last year they generated 97 million. That's 3.5 times free cash flow. And over the last 5 years, they've been selling for 5 times free cash flow. That's super low. So if you believe in this company long term, or it'd be a buyout option, you just have to understand, why is revenue plummeting so much? I mean, revenue is down a lot, guys. Does anybody know why? Are you paying attention to me?
I don't know why, I would assure you. But I love you nonetheless.
I think it's an energy drink. Ben Rourke says, is he asking it's an energy company or energy drink? Good question.
It's funny.
Oh my God, it's not an energy company, drink. I thought it was an energy drink. Didn't somebody say energy drink? Didn't somebody say energy drink?
You thought you were looking at Spark Energy drink. This is Spark Energy.
You said to me, you literally said to me.
Paul, I assure you, if there's a choice between me or you knowing what the hell is going on in this show, it's not me. We've gone over this
You literally said you've had their drinks.
a few years ago. No, I've never. Don, do you drink this stuff? Okay. This is exciting. Paul, you're so excited about the. Listen, folks, I can assure you, this is the in-depth analysis you're going to get from this channel. Is just amazing. Yeah. Okay. Sorry. So now they're saying I'm lying. I don't know what the hell I'm saying. Of course, I don't know what I'm saying, guys. That's why I'm on this show hosting it. Okay. Shall we move on, Paul?
This explains the increase and decrease in revenue so much. Energy prices fluctuate like crazy. This is exactly why it's happening. If you believe energy prices are going up in the future, this would be a good opportunity to buy.
They're all saying I punked you. That was the
I 100% got punked. That's why I went to FIZZ. I went to FIZZ immediately because I'm like, oh, you guys want to buy some drinks? Here's a good company. FIZZ did look good.
Would you like to address Carnival Cruise? This has been one of our most popular topics. You want to give it a little once-over, Paul, to see what the hell's going on? People are asking about your stocks, your options. I would say, folks, if you're interested in what Paul is doing, you have the unique opportunity of joining the Patreon and learning exactly what someone does with a lot of money in terms of buying stocks, buying puts, calls, options. You will see Paul's entire portfolio and mine. Not as impressive, Paul, but I'm not doing too shabby for a normal guy with making a living, kids, and a mortgage. But go ahead, Paul. You want to look at
this is CCL. Somebody said it crossed. It crossed back here in July of or August of 18. So it's not really like so. CCL, we've gone over this. I think before when I first did this analysis back in March or April, I thought it was a $50 or $60 stock. Since then, they issued about 1.2 billion and more shares. By the way, we're talking about Carnival Cruise Line, the cruise line, or we're talking about?
I think it's boats, rowboats, Paul. It's just like a rowing company.
Just want to make sure.
Yes.
We're not talking about going on Carnival. Anyways, but they've issued shares to dilute people. So when they diluted everybody by 10%, my $50 to $60 a share goes down to $45 to $55 a share. I just take that dilution percentage and deduct that. So I think they're still a $45, $55 company. I currently own shares. I have covered calls written now at $26 a share. I was at 23. I lost a little bit of money on my 23 one. Rewrote them at 26. I'm okay here. They expire. My $26 ones expire on Christmas Eve, so I'm probably going to do okay on these. But I started buying at like I started buying at 12. My cost basis was $14.50. But again, I'm in this for the long haul. I'm going to keep writing calls as it goes up. I want to buy more shares as it goes up. I'm going to sell puts on this thing, etc. So
Jared's saying the 50-day crossed. Are we looking at the right chart, Paul? I'm sorry.
I don't look at the 50-day.
Oh, go on.
I look at the 200 versus 300 for long. So I want to get more. I want to do less trades, but have more trades work out. And we have found that the longer-term trend lines, 200-day versus 300 days, even though you do less trades, when you do them, they tend to work out better in the long run.
That's right.
Do.
Well, yeah. See, Bitler's reminding us not to get confused with Carnival clowns, Paul.
Yeah, that's exactly what I was.
Carnival boats.
Now, what I want to do though here is what I talk about is I'm probably going to write some CCL. Just wait.
Okay, sorry, Paul.
I'm probably going to write some CCL puts here soon. So, CCL is currently selling for $21.46. Okay. Now, I'm going to go to December 24th. if I want to buy CCL at, say, $20 a share.
What's it at right now?
$21.47.
Okay, go on.
So if you look right here, kids, $20 a share, I'm going to get 47 cents. So
That's pretty good, eh?
yeah, 0.47 divided by 20 equals 2.35%. Is that right? Somebody tell me that's right. No, that's not right.
2.3. It is 2.35%, Paul. How, and you just do that?
Well, it's actually pretty simple.
Oh, no, it's not.
It's 4.7 divided by 2.
Paul, how many Americans can divide that number without the decimal place?
Well, okay, anyways.
Go on.
2.35% is my ROI over a 10-day period. That's 0.235% a day times 365 days equals 80% or something like that. I'm getting an 80% ROI. Now, the key here is I have a 26% chance of getting these shares if I want to do this. And by the way, Trader Mo, we should talk about this. If we do believe CCL is going, we've only been writing covered calls. We should be writing puts also. Even though it's at 20, we've got to get over the fact that we bought them at 14 and we hate paying more for shares. We wanted the shares to go down.
Go on.
It's hard for me to go pay more. Most people sit there and go, oh, I bought it at 14, went to 20, let me buy more shares. I think the exact opposite. I go, damn, I bought it at 14, now it's at 20. I don't want to buy more shares. But I got to remember that if I think it's worth $50 a share, 45 or 50, I should be happy buying them at 20. Or some other number. Let's say I wanted to go lower. Let's say I wanted to go to $18 a share. I'm going to get a lot less money because it's a lower price for the same day. I'm going to get 12 cents. Okay? So it's 0.12 divided by 18. I'm picking the easy ones. Okay? 0.0067% divided by 10 equals 0.00067 times 365. Somebody tell me what that is. So 2/3 of that, 240, 24%. Is that what it is? Anyways, it's around 24% return. I like that one a lot because this one only has an 8% chance of hitting. And it's still giving me a pretty good return on my money. Why are you laughing, Nate?
You keep looking at me to like check in on these
you have a calculator. I see your calculator open right there.
I'm looking at other things.
His calculator's literally open his phone. I see it right there.
I mean, we have a comedy show here, Paul, too. So people are both like making fun of us, busting chops, and asking serious questions. I mean, this is what we get into here.
So this one might be something I look at for $18 and go, hey, I'm going to write this for December 24th because if I get it, am I happy owning his CCL at $18? Yeah, I'm really happy. So I'm okay with that. I don't have a big position on CCL right now relative to my portfolio. I have about 1/10 the position I want. So I have a lot of room to go write puts at other. Now, if I want to go out further, let's say I go to January 15th. And I still want those same, let's say I go to $15 a share. Okay. January 15th, $15 a share is paying 18 cents. Has about a 6% chance of hitting. So 0.18 divided by 15 equals 1.2%.
That's true.
Yep. Divided by 32 days times 365. Somebody want to tell me that? Times 12. So it's about a 15% return, roughly.
13.6.
Okay, 14% return. Okay, not bad. I'm going to get paid 14% of my money annualized to sit here and wait for CCL to go to the price I want it to go to. Now remember, guys, you have to do $100 shares at a time. So you have to have $1,500 available just to buy one of these contracts. You have to pay $15 for that contract. So you actually might not even make money on this one if you're just buying a regular. Maybe it depends on what broker you're with, but some of them are free, some of them charge you money, etc. So I'm going to go buy a bunch. I'm going to go sell a bunch of these. That's the way I look at CCL. I still believe in the thesis. They're still losing money every quarter, but I think with the vaccine coming out and things like that, once the numbers start happening, the cruise lines actually open, I think the stock will skyrocket.
Do you want to look at 3M or Cinemark?
Yeah, hang on a second. What's Trader Mo saying?
He said they should just, why don't we write both and start staggering down?
Let's do it. So Mo, let's make a note to do that today.
Everything that Paul does with his portfolio, you'll be able to see in the Patreon if you join. You definitely have to be in one of the higher levels to get access to all this, but the highest level we offer, you will basically be texting with Paul all day of your whole life. Right, Paul?
We talk about everything. We talk about Mo's dating life, my dating life. We talk about investing. We talk about everything in there.
It's a great community. We love you guys.
Yep.
Yeah, a lot of people are saying that theaters are kaput. They're done for. I mean, is that true? What do you think, Paul? Cinema, movie theaters?
I really enjoy going to theaters. Is it like malls in the sense that with all the digital stuff happening and all the streaming, it's going to become less and less popular? I'm sure it will. It's just a matter of, does that mean everybody's going to go out of business? No. So, I haven't looked enough deeply into the theaters. I think you really got to look at their 10Ks. I mean, because the theater hasn't opened up in how long? Like now they're generating revenue by renting out the theater for like $100 to people to watch a movie with their family and friends. You know what I mean? Have you seen this?
I'm doing it.
Are you doing it?
We're watching Christmas Vacation here in a week. So like 8 of us are getting a theater, and it's $100. Yeah, they're trying. Remember the magic of going to a drive-in when you were a kid, though, Paul?
I went to one drive-in in my entire life.
Didn't like it. You get out with the kids, you run around. I mean, like my yesteryear, I guess, So like the theaters, it is nice going to the theater. You get the popcorn.
I like the popcorn. I think it's like going out. You're just like, you get the pop, you get the little Airhead candies.
You do it. Yeah, you do it all.
Those are really good, aren't they?
And you get annoyed by everyone around you. Isn't it wonderful?
Well, people will answer the phone like literally in the theater. Like I've been in a theater before. Somebody goes, "Hello? Yeah, I'm in a movie right now. Is it quick?" And it's like, we were all like, and somebody actually goes, "Are you serious?" Like literally, he was talking like full boat.
Okay, why don't we keep going? Do you want to look at 3M?
Yeah, let's look at 3M.
Now, I love this company because my company, DGF, we sell to these guys. This is good stuff.
So 3M is in Matt's hometown. Check out chessgoals.com.
Will you erase your board over there?
Oh, yeah, good
Make
call.
sure you guys are smashing like as always. We're getting ready, Paul, for our 2 o'clock blitz of people jumping on at 2 o'clock. So the comments will be coming. Get them in right now, guys, because the comments will be flowing here in a minute, like the salmon of Capistrano, Paul.
All right, 3M is located in Minnesota. The company is well known for its research and development laboratory, and the firm leverages its science, technology, blah, 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 blah. 4 segments: safety and industrial, transportation, electronics, healthcare, and consumer. About 60% of the company's revenue comes from outside the United States. Wow, that's pretty good.
60?
Yeah, 60%.
Market cap of 100 bill?
100 billion, guys. 100 billion with a 3.4% dividend. So they have to pay $3.4 billion per year in dividends. So we want to make sure this is safe. PE, just barely an X, 20.46, but a great profit margin, 17%, with a pretty decent gross margin of 48%.
Good stuff. How about
So 1X, 1 check.
revenue growth over the past 5 years? Pillar
Let's
number
look at
3.
that revenue growth. My guess is it's not going to be the greatest because it's a big company already, but we'll see. Revenue growth over the last 5 years. And like I said, 30 to 32.1. Still a check, but guys, this is crawling. I mean, look, 10 years ago they did 29.6. Now they're doing 32. This company is going to crawl. Absolutely crawl. Oh, cool. I got a different color on the other side. I didn't realize that.
Come on with that. Look at you go there.
Look at that. I can highlight like that as opposed to crossing out like this. Oh my God, look at that.
Keep going, Paul. Pillar number 4 is profit growth. I would assume the profit's not too great either.
I bet you it's probably growing much faster than the, nope, not at all. In fact, it's an X, 4.8 to 4.75. And just in case you guys want to see it, there it is right there.
That's absolutely not helping the viewers, Paul, I would assure you.
So this is an X, guys. They've gone from 4.8 down to 4.6. It's kind of all over the place here, but it's pretty consistent. Look at this, 4.6, 4.28 over the last 10 years. Guys, this is a boring blue chip company. I love boring blue chip companies.
What's blue chip more the better
Basically,
than?
like, no, blue chip's more like, big companies like generate a lot of cash, they're established, not a lot of growth. It's, 12, 13, 14 years ago, my friend Mr. Moskal said technology companies will become the new blue chips, and he's right. Like Microsoft, Cisco, these big cash generating companies aren't going to grow 20, 30% a year.
You saw the movie Blue Chips with Shaquille O'Neal in the early 90s.
I have an autographed version of blue chips.
Come on.
Well, because he, so we'll tell everybody, he lived in my house when he played for the Cavs.
This
He rented
is
my house
Shaquille
for me.
O'Neal in 2017?
So here's the better part. No,
Go on.
2017.
I don't know what year it is.
2009.
Oh, that long ago, sorry.
So anyways, I knew you in 2017. How would you would have known that?
I don't know what
So he
day
was in
it
it,
is.
and here's the thing, though. You know who's assistant? His assistant and I became close.
Go on.
His assistant is the main character in Blue Chips, who was point shaving.
But
He wasn't the main character. He was the guy who was point shaving in it. So I called him one day.
this is Shaquille O'Neal.
Shaquille O'Neal, his assistant
Go on.
in real life is an actor, Anthony Hall. And I texted him one day. I said, Anthony, I didn't know you were in Blue Chips. He's like, oh yeah. He's like, I was in that with blah blah. I said, hey, can I get you to autograph a version for me? I didn't ask for Shaq to. And I showed up at the house and he gave me Shaq and him both signed it. So anyways,
That's very nice. Keep
All
going
right.
on 3M.
shares, 625 million down to 577. Check mark there.
Okay, how about current assets greater than current liabilities?
I gotta find that thing actually.
A signed copy of Blue Chicks?
Now, where is it?
I'm sure it's worth tens. Make sure you guys are
14 billion in current assets,
smashing that like.
7 billion in current liabilities. Great. So they have $7 billion extra.
Wow.
All right, that's good.
What
I'm
about
glad to hear
total liabilities?
it. 33.
Oh, okay.
Now for my favorite.
Free cash flow growth, baby.
I'm licking my chops.
Cash from operations minus capital expenditures.
All right, so remember, they had $3.5 billion essentially in dividends. So we want to make sure that's safe. So $5 billion to $5.3 billion. Check mark there.
Nice.
They have enough to pay. It's a big percentage of their free cash, so that's okay. So $5 billion and 5.3. Now let's do the average of the last whatever. So 5.2, 4.9, 4.9. So ready? 5.2.
I got it.
The average is about 5.
Yeah, it's 5-ish. Yeah.
So 5. Now here's the deal, guys. This is not a fast-growing company. You don't want to pay a lot for this. I'm thinking at most 12 to 15. So you want to pay between $60 and $75 billion for the company.
It's $100 billion.
It's currently 100. So as attractive as it seems, you're not going to get growth out of this company. You've got to remember that. The only reason to pay a premium is because you're expecting a massive growth in free cash flow. All indications here are that their cash flow and profit and revenue are not going to grow a ton. So don't go overpaying. I say on the high side, wait for a 25% drop in the company. Now, should we look at their options? The options are going to be garbage, but 25% drop. What's the company currently selling for? $175 a share. So 25% drop would be $42 roughly. So call it $130 a share. I'm basically calling it $130 a share. That's what I'm sitting there saying is what I would sit there and say. It's $130 a share. Maybe start picking up some shares. What's everybody saying?
You know, they're still talking about the malls. We have people jumping in. We thank you so much for watching. You guys are incredible, guys and gals. I think we got a couple patrons out of this. This is great. People have been following us for a while. It's good to hear. Bullet keeps asking for SLG, which is SLG is SL Green Realty. It looks intriguing, Paul.
Well, what do they do?
It's a real estate investment trust that primarily invests in office buildings and shopping centers in New York City.
I would rather, that does take a lot of thorough analysis. I'd rather somebody go to Patreon, join it, and talk to us individually about that in the chat, in the big chat, because SPG took some research ahead of time, discussing it, understanding it. Office, if you're not pro on, I think Office has the same issue about, not the same, quite the same as malls, but Office is going to have issues too. So these are easier companies to do when they sell products or services. It doesn't require as much financial maneuvering here.
Someone asked about someone just asked about waste management, WM, and Trader Moe's just saying it's basically way overpriced, which it looks like on its stock ticker already.
Why is it overpriced?
I'm sorry. It's as high as it's always ever been at the moment.
Does that mean it's overpriced?
Well, that's true, Paul.
And it's not the highest it's ever been.
Mm-hmm. Close. Mm-hmm. Do you want to look at it? Sure. You want to look at the waste management?
All right, guys.
Let's look at it.
Basically, it's a $50 billion company. It's paying a 1.9% dividend, so let's call it $1 billion per year they're going to pay in dividends. So remember, we want to make sure that the free cash flow can support the dividends.
How's the PE ratio?
Awful, 33. So already sounds overpriced there. Profit margin, barely a check, but it's there. 40% gross margin. So we have 1x, one check, 32 PE, $1 billion in dividends. That's the quick recap off this main page.
Revenue growth, pillar number 3.
I bet you this is going to be very low revenue growth.
Really?
Better than I thought. 13, 15.5. Check with consistent growth every year. A company like Waste Management will be buying a lot of smaller town smaller trash companies within a city. So if a trash company builds up and they generate $10, $15 million a year, they're going to start buying these guys and adding to their portfolio. So there's a check here for this one. It's done about, what is that, $2.5 billion on, so 20% growth over the last 5, so 3 or 4% growth a year.
Profit growth over the past 5 years?
Profit growth, 753, 1.67, check mark there, over double. So they've over doubled their profit though. And by the way, let's go back to operating income. Now here's the deal. Here's where we look at operating income. It went from 2.1 to 2.75. Remember, operating income is the profit they make before interest and taxes on their actual business. It's only up 30%, yet their profit has doubled. So keep that in mind. Why is that happening? You want to understand why is their business operations, there must be some financial engineering happening. Maybe less debt or they're getting lower interest on their debt, something like that, because their operating revenue is only up 30%, yet their profit's doubled. There might be some other income items in there. This shows you how the business is actually doing from a profit perspective from the operations of the actual business. Number of shares outstanding.
Pillar number 5 is number of shares outstanding. We want this going down.
It is going down. 452 to 424. Check mark.
How about current assets greater than current liabilities is pillar number 6.
Let's check it. Let's check it.
Dave, I see you.
Look how much better this is now that we use my laptop. Remember how slow it was on there?
Yeah, you're doing great. Lots of questions still coming in, guys.
3.36 versus 2.8. So they have enough by $500 million to pay their current bills.
Okay, that's nice.
And then now the favorite, free cash flow.
Free cash flow growth, pillar number 7, y'all.
Okay, ready? 1.3 to 2. Check mark there. 1.7, 1.6, 1.8. You ready? So that's 3.
I'm done.
6.
Divided by
4,
5. It's 1.68.
8.4 divided by 5.
1.68.
1.7 times 20 equals $34 billion. I would not pay 20 times on this one because it's a slow growing company. Call it 15 times 1.7 is 25 billion roughly. What's it currently selling for? 50 billion? Yeah, cut it in half.
Really?
Yeah, cut it in half. Guys, it's growing, but it's not growing a ton. It's growing 3 or 4% a year in revenue. You saw the operating income was only growing 5 or 6% a year. I mean, you have to get your money from somewhere. And if you're just banking on somebody else paying you more money, that greater fool theory, it's not going to work. Over long periods of time, it's going to be reflective of the cash flow. Now, granted, their cash flow last year was $2 billion, so you could argue that 50 billion divided by 2 billion is 25 times. But I want to go for longer periods of time to take out fluctuations in cash flow here and there. So maybe you pay 40% less, maybe you pay 30% less, but it's not where it's at today. I'm not buying it today at this price.
Those numbers are back in like 2017. It got down that low, so.
Got down what low?
Down to half, 40% off.
Yeah, you're right. 2016 even. Let's see where it was on the day the Cavs won the title. About $63, $64.
19th of June?
Yeah, that should be added to our metrics. The Cavs title day price.
That is true. That's very nice. David is correct. We should start saying tiek mark. Like
tiek, like no, what's it
Russian,
called?
yeah, tiek mark. Pietet mian his miani. Okay, wow, Paul. I mean, people are all over the place. Yeah, people are still talking about, what about WCC? What is that, Paul? WCC, you know what that is?
WCC? You down with WCC?
Yeah, you know.
WESCO International. Are they insurance?
We've looked at this before.
Nope, they're industrial. Have we?
WESCO. You know, I sell to this company. What do they do?
A value-added industrial distributor that operates across 4 distinct markets: industrial, construction, utility, and a bunch of other ones. A company offers more than 1 million products to its 78,000 active customers.
That's me, yeah. So my company, DGF, DGFspray.com, we sell our graphite spray to this company, WESCO. Let's look at it. This is fun, Paul. Who brought this up?
That was your cough to get my attention. That was
fun.
funny. I was just like, I didn't even catch it.
Who's coughing?
Dom was trying to get my attention.
What for? What's wrong with Dom?
Because I had all the writing up here.
Dave requested this one. Dave, thanks so much.
$4 billion company, $3.85 billion.
Okay.
30 PE X, 2% profit margin X, 19% gross margin. Okay, so my guess is they don't hold much inventory. Because for these kind of margins, they better be just like a drop shipper. Do you sell them inventory, or do they sell it for you and then you just ship it?
No, we sell it to them and then.
Do they buy it from you?
They do, yeah. WESCO International, yeah.
Guys, this worries me. This profit margin of 2%. If they're holding inventory, why are you laughing?
But someone said, can we analyze DGF? You don't want to see the numbers on this company.
It's probably pretty good.
Yeah, maybe. One day. Well, maybe so, Paul.
This is to hold inventory and only make 2% to the bottom line. Like, I can understand they're just a middleman. They're just like, hey, Seth, we're going to sell your product. We're not going to buy any of it from you. But the second we get an order, you sell it to us. We'll pay it to them. We'll handle the paperwork.
Yeah.
Is that what happens?
No.
They actually buy it from you.
Yeah. I mean, I don't know, but I mean.
What do you mean you don't know?
I don't know what they're doing with it once they get it. I don't know.
Well, but when they get it from you, they've already paid you for it.
Yeah. Wow. I mean, they have net 30.
Wow, 19% gross margins off. I mean, I don't like it.
Awful.
Yeah, I mean, to hold inventory and only make a 19% gross margin?
Oh, I see.
You know what I mean?
Mm-hmm.
And 2% to the bottom line?
Yikes.
Yeah. What was that? Yeah, womp womp is right. That's the problem.
I got the womp womp right here. All right, Paul, keep going. You want to look at revenue growth?
Yeah, let's look at revenue growth.
Okay.
7.5 to 8.4. Check mark there. It's a lot of money to go to make. It's a lot of money to bring in revenue to generate 14 cents.
Okay, keep going.
210, 223. Check mark there. Can you just keep doing womp womp for every single one of these?
Oh, they're all bad? Oh no.
Let's
Okay.
see.
Let's keep going. How about shares?
Shares outstanding, check mark.
Okay.
43.4 down to 43. I have no idea how they're buying back shares when they make $11 a year. But let's keep going. Balance sheet. Total current assets, 5.6 billion. Total current liabilities, 2.5. Wow.
What's the wow? Sorry, I missed it.
I mean, they have $3 billion more than their current liabilities. So it's a check mark there as well, guys.
Okay.
Yeah, that's perfect. Quarterly is great. All right, their free cash flow growth, guys. Ready? 261 to 220 to 180. X. That's an X there, guys. So 283. Oh, what are you giggling about, Seth?
I'm not. That's not me. Keep going.
128, 260. Jesus Christ.
Come on, Paul. The average is 222.
10. Guys, the margin is so low, it scares me. What do they do when there's a downturn in the economy and people aren't buying industrial products anymore and they have 2% margin?
The market cap is $3.8 billion.
Exactly. I would want it the screaming deal of all screaming deals to buy this company. And their cash flow is down. I mean, I don't know. Let's look what their revenue did during the first quarter when the economy came to a crashing halt. And you'll see what...
Paul, some of our fans are just really hilarious and funny. They're just good. They're just hilarious. Cameron said he keeps writing. Some people just keep writing their question. He just goes, "I'll shoot my shot one more time." He wants to look at UNM. Cameron, just for that hilarious comment, we will look at it. We're going to look at Spark Energy Company, all the energy companies, all the energy drinks, and UNM.
Look at the revenue last quarter. Look at the revenue last quarter. It skyrocketed because they probably have pent-up demand. They probably had pent-up demand from other things. They made $80 million last quarter. Wow, $80 million on $4 billion. That means they made almost 2% margin. Oh my Lord. Nope, they didn't. Sorry. That's a lie. It was 1.9 again. I mean, guys, if you want to buy this company, just be very careful. I don't like low margin companies like that. That just drives me nuts. Low margin, you have no room for error. You have less room for error. It's one thing they had high gross margin of like 50, 60%, and they could generate 10 or 15% of the bottom line. They have low gross margin, holding inventory, and getting low profit margin. I don't like it.
RJ, are you serious with Tootsie Roll? I don't even know what you guys are talking about. I thought that was some sort of inside joke. But Paul, let's look at UNM, which is Unum Group, is a Chattanooga, Tennessee-based Fortune 500 insurance company. Do you want to look at this?
Well, insurance, are they underwriters? Products?
I don't know.
Okay, so insurance is like banks. There's a different way to look at the numbers than just looking at the financial statements. So let's disregard those ones. So banks and insurance companies you don't really look at their free cash flow to see if they're good companies. You have to look at other, like I started learning banks recently. We have yet to talk about free cash flow. In fact, the guy said to me, we're never gonna look at free cash flow. It's a useless metric because you don't even know what the free cash flow really is. So insurance companies are all, go read Warren Buffett's annual reports about insurance companies when he talks about insurance companies, and their big way of making money is how much money do they make off the cash they hold, the float they have on hand. It's not just necessarily just a matter of, they make their money off investing the cash flow they get in today.
We're going to look next at Tootsie Roll Industries, Paul.
They actually exist?
This is news to me.
Why aren't they owned by Mars?
Tootsie Roll, a new for the Everything Money show. Tootsie Roll, baby. What's the market cap? Some of the other people are saying he is serious. So.
$2 billion market cap. On the nose, almost.
Tootsie.
PE, 18.68. Profit margin, 15.6 with a gross margin of 37. We have 2 checks so far.
Hold on a second, Paul. We might be swimming in Tootsie Roll juice here.
Basically a 1% dividend yield. So we need $20 million in free cash flow to pay that dividend yield.
Prajesh, I see you there. We're gonna do that one next, baby. I got you.
Prajesh, join the freaking.
He's
okay. Good.
He's good. Don't worry about it. He's good. Tootsie Roll. Let's do revenue growth over the past 5 years, Paul. Let's do it. 2 checks so far.
Oh my Lord. 536 down to 523. X.
Uh-oh.
I mean, it's candy. I don't think candy is a huge growth market right now.
But it's going down. Okay, how about profit growth, Paul?
66 to 65. X again.
Okay, no good.
No good. Let's see their number of shares outstanding. It's a check mark here. 69 down to 67. Check mark. And at the beginning of the decade, it was 73.
Do you like Tootsie Rolls?
Love them.
Just the general ones or the flavored ones?
No, the general ones are great. Strawberry is awesome too.
Well, I mentioned Tootsie Roll juice, which people are laughing about because, like sometimes it's so juicy that brown ooze just goes out the side of the mouth, Paul.
I was thinking Tootsie Roll juice was something else.
Oh, sorry. That's my. Yes.
Total current assets, 315. Total current liabilities, 78. Plenty of cash there.
I like that.
Oh, wow. Total liabilities, 221. So, 315. Total liabilities. Check mark there. Decreased by $90 million. Check, 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 check. This is a good one, guys. They have more cash on hand than they have liabilities total. So, where the company's not a $2 billion company anymore, it's $1.9 billion.
What about that Tootsie Roll song, Paul?
The Tootsie Roll, that thing? You play it?
Tootsie Roll, Tootsie Roll. Well, we get a lot at weddings, so, what we're up to. All right, what are we up to, Paul? We're at, how much?
Cash flow.
Free cash flow, pillar number 7, baby.
Up from 76 to 80. Check mark. Remember, their dividends were $20 million a year. So they can definitely support the dividend with this. Now, you ready for the average?
Oh, hold on a second. RJ is saying this is one of those companies that might be going down, but it still might be worth something, Paul.
Oh, 100%, he's right.
What are the numbers in? 76?
76, 82, 26, 73, 80.
80 divided by 5, 76. We need a womp Tootsie
What?
Roll sound.
There was a 20 in there.
I'm sorry. Do it again.
Wasn't there a 20 in there?
Yeah, but
Maybe it still works. 76, 82, 26, 73, 80. Yeah, how's the average 72?
divided by 5. 70. I have 65. Sorry.
65.
Sorry about that. What did I say?
72.
I might have just repeated the last number you said. I'm out of my damn mind. I'm trying to
guys.
show and.
This is a company that's making 65. So right now it's at $65 million a year in free cash flow.
Okay, what are you
and
multiplying
$2 billion,
that by?
that's 30 times free cash flow. So a company that's revenue is basically stagnant, going nowhere. Profit's stagnant, going nowhere. Free cash flow is stagnant, going nowhere. Do you want to pay 30 times that free cash flow?
Do we?
No.
Oh.
I hate to say this, guys. I want to pay 10 times. Wait till the stock drops by 60%. Yeah,
Paul.
Oof is right.
Now,
Hey, if you want to pay more power to you. But you're not going to. But unless they have some major growth plan that's planned that they're going to be able to sit there and increase their revenue by 5, 10, 15% a year, how do you get there? You got to pay lower multiples. When your cash flow is stagnant, if you have $1 a year for 5 years, why would you pay? And you want to. I mean, I look at it going. Let's say paying $3, paying $2.50. Gives you an ROI of 10% a year. Every dollar above that just drives your ROI down. So I'm looking at going, I'm not getting growth in the company, so I got to pay less for the cash flow today.
this stock was 30% higher last May 2019.
I have no idea why. That's why it's 30% lower today.
2 Mays ago.
I mean, guys, this is tough.
It's a no on Tootsie Roll.
By the way, in February of 2001, it was at $34.
Cameron asked, do you care about book value per share and price to book as much as PE?
Great question. This is one of the few metrics, price to book is one of the few metrics that over time I've actually said doesn't matter as much. Back in the day, 50 plus years ago, when most companies were manufacturers that had plants, they had a lot of equipment, book value really mattered. You're buying their assets, et cetera. Now we have a lot more service-oriented businesses. I don't think book value matters as much. I never look at it, essentially. I never, ever look
Paul,
at it.
I'm going to interrupt you. We have breaking news from CNN. Fang, your favorite Chinese restaurant, is 10% off your bill of 50 or more.
Did you get that text?
Just letting you know from Trader Mo.
Did you get a text from that?
No, Trader Mo announced it live here on the show. And again, folks, this is the breaking news you're going to get.
And here's the
from
big
us.
breaking news.
Go on.
Giannis just signed a 5-year, $228 million contract with the Bucks.
Oh, he's staying. Giannis is staying.
That's awesome. Now, he might request a trade like all those other guys, but I'm really happy he did that.
Because you like small market teams.
I like small market teams. I like him. He seems like a hometown kind of
Down-to-earth guy?
Yeah, he wants to go win a championship with the Bucks, and I really hope they do.
Over LeBron, though, Paul?
LeBron's got a championship now. I want LeBron to win more titles, but if you told me this year right now
Come
who
on.
I'd want Giannis.
LeBron. You misspoke there. Let's look at...
I want LeBron to win more titles.
Let's look at ServiceNow Inc. Paul, ServiceNow is an American software company based in Santa Clara,
Seth, you have a
California that
call.
develops cloud.
Seth, you have a call.
Is that still coming through? Unbelievable, folks. I'm so sorry. I cannot.
Stop talking about boring sports is what.
You said it, David. Never. Yeah, phone calls. Sorry. I can't
David
believe it,
Spicer.
guys. Paul, your phone. Oh my gosh. Let me put mine on airplane.
What am I talking to? True Source? What am I looking up?
You got it. ServiceNow, Paul. ServiceNow.
Oh, their ticker symbol's now. That's awesome. Okay, what do they do? ServiceNow provides software solutions to structure and automate various business processes via a SaaS delivery model.
I apologize for that phone, guys. Paul, I didn't even know, Paul. Somehow my phone goes through to the board, yada, yada. You should see the studio, guys. We'll do a lot. We should do a live.
Why don't you just disconnect the phone from your board?
Well, I'm not that smart, Paul. We're not all
take
you.
Bluetooth off, genius.
I just did that now. Thank you for smashing the like button. We like you guys. We love you guys. Appreciate it.
And another high profit margin business, guys. No, this is kind of recent write-offs. We're fine. $100 billion market cap, 150 PE. Everybody, relax.
Ain't nobody got time for that.
I don't think it's that big of a deal right now. Is this still an X? I don't think this 150 is real. So just relax, everyone, before everybody starts hyperventilating and going crazy.
I am already. Keep going.
1.1% profit margin. It's an X
terrible,
again, but
terrible.
again, I don't think it's real. Their gross margin 78%. Here's why I don't think so.
Go on.
Their trailing 12 months income is $700 million on $4.2 billion. That is roughly 17% profit margin. And on a $102 million, it's still really high, but it's still about 100 and some. But let's go see if there was some major write-offs or lack of income here recently, and that's what caused this massive jump.
Profit growth over the past 5 years?
Revenue growth we want to do first.
Revenue growth. Sorry about that. Revenue growth. Pillar number 3.
How many stocks have we done? Like $1 billion, and you still don't know this thing? Okay. $1 billion to 3.4. Check mark. I had to think, oh, wow. Look at this. 10 years ago, they did 73 million. 73 million.
Look at that, Paul. Would you look at that?
They must have done some major acquisitions here or something. Somebody find out they did it. Oh, we can find out ourselves. That's pretty awesome. Big jumps.
Profit growth. Pillar number 4.
Let's look at their operating income real quick. Ooh. Ooh. Oh, their net income just recently started making money, guys. All right, so negative 200 million to a positive 626. It's a check mark, but not that great. Number of shares outstanding,
Pillar number
awful.
Ain't nobody got time
155 to 186. Jesus Christ.
Not awful, Paul.
155 to 186?
20%? 20%?
Increase
Yeah, that's bad. Okay.
in shares outstanding. That means for every share you owned before, now you own 1/6 of that same share.
Current assets greater than current liabilities. What are you thinking of this company already, Paul?
$4 billion versus 2.8, check mark there. Almost enough money to pay off all their liabilities, though. That's pretty cool. Listen, this might be like a really growing company, and that's why they have this issue.
This is ServiceNow.
I need you now, more than words can say. I need
Paul, if you
now.
sing too well, they're going to spike this video and take away monetization because, that voice of yours.
All right, you ready, Big Shot?
Go on.
So first off, we're at 220 million, and now we're at 900 million.
Wow.
So definitely check mark there. So guys, this is a fast-growing company, so we're going to want to pay a much larger. Just go ahead. 35, 490, 660. So 220. 35.
I got it. 441. What multiple are you choosing, Paul?
30.
Why is that? Why is
Because
that?
it's fast growing. It's quadrupled in the last 5 years. And guess what, guys? 13.2 billion. What's the company selling for right now?
Drum roll, please.
102 billion. So it's going to drop 87%.
Do you like it?
I mean, it's currently selling for 120 times free cash flow. No, 200. It's currently selling for 250 times. No, okay. So last year it's selling for 110 times free cash flow. It's selling for 250 times 5-year free cash flow. I mean, you decide what you want to do. I'm not touching this thing. I ain't touching it. Let's go look at their quarterly numbers. I want to see their quarterly numbers. What's causing these massive fluctuations?
Yeah, this thing's skyrocketing.
I like the operating incomes going up. Look at their revenue quarterly. It's definitely up a lot. I mean, they're growing like crazy, but you still, just because it's growing doesn't mean you pay whatever you want for it. Why not pay $200 billion for it then? You still got to sit there and say, what's that future stream of free cash flow going to be worth to me today? Wow, we're already over. It's already past 2 o'clock.
Yeah, you want to wrap?
I think we should wrap. This is pretty good.
Okay, Paul will now rap for you guys.
I'm a second. I've been winning.
Don, lay the beat down. Lay the track.
I lay the track. You lock the flow.
Is that how it goes?
No, that's from, you know what that's from?
No, I don't.
Every Breath You Take by Puff Daddy's version of the Every Breath You Take police song.
Oh, that's like 95 or something.
Yeah, well, whenever, no, it was later than 95 because he died. Biggie died at that point.
Oh, okay.
Wrote the song for Biggie.
Oh, okay. Yeah. Those are the days.
Are you going to dance like Puff Daddy when he was like this all around the room?
You know, I mean, I had that CD.
Oh, it was a great song.
Yeah, you throw
I still
with
listen
the
to it.
CD and the CD player.
Did you
and
cry when you heard the song?
Not necessarily that one, no. Just about Biggie and Puffy?
Biggie and Puffy, man.
Um,
Puffy's gained some LBs lately.
Pardon?
Puffy's gained some LBs lately.
He's not as svelte as he used to be in the
Oh, he used to
early
be
90s.
jacked. Now he's like, he did a video where he's jumping off a diving or jumping in a pool, and it was like, someone's making fun of him. Anyhow.
That's you, bro. That's you all jacked up in that shirt.
I don't know about jacked up.
Looking
but
spicy. Can Paul remix 90s rap for the Patreon channel? Absolutely.
Should I just have videos of me rapping? But what happens when they say bad words?
Well, that's for our Patreon.
Well, not bad words, the bad word.
Oh.
Because, you know, a lot of these songs have the bad word, and you can't really say that.
Republican?
I once, yeah. I had a dream the other night that you were a hardcore Republican.
Yeah, you are dreaming. Any questions?
That doesn't understand
Has
logic
Paul
yet,
seen The
but
Queen's Gambit?
I have.
You did
I
not
wasn't a
like it?
fan.
You were
I was not a fan.
you were bored? I loved it.
Loved?
I did love it. My wife and I loved it together.
Hey, Matt, is it worth it?
Oh, wow. Yes, Trader Mo, you're correct. I played WAP for Paul one time.
Have you really? I don't remember it.
Yeah, and I also played
I don't know it at all.
Trap Bunny Bubbles.
What
Don, you know what that is? Yes. I played Trap
it for
Bunny
kids?
Bubbles. I showed you this Trap Bunny Bubbles.
Oh, that one?
With the wind, yeah. Yeah. Analyze
And Donald
WAP.
Trump is a misogynist.
Paul, you should do WAP. Yeah, that'd be great. Paul sings Missy Elliott during chess lessons. Is that true, Paul?
Yeah, is it worth it? Let me work. Is that not Missy Elliott?
Oh, but are you sure? Because that's what that song you were just saying.
Is it?
Yeah.
Then it is, sir. Is it worth it? Let me work it. Let me drop down, zip it, and reverse it.
Guys, yeah, that's right. Put my thing down, flip it, and reverse it. Okay, guys, I think we've said so much, Paul.
We've said enough. See you guys Thursday at 1 o'clock. Again, watch for videos every day, hopefully. 1 and 7. Actually, not hopefully. There'll be a video every day at 1 o'clock and 7 o'clock,
Yep.
or a live stream at 1. This has been good. Keep it coming. Keep showing your friends. We're going to hit 3,000 subscribers this week.
This week, yeah.
Yeah, we're going to hit it this week. And everybody
exciting.
keeps saying you guys should have 1 million. For me, it's funny. I get a lot of good support from my friends. They say this is going to be a big channel. But I really do mean it when I say, and Seth and I disagree on this one, I do mean it when I say, like, growth isn't as important to me as I want the growth, but I want it to be, like, useful growth with good people. As cheesy as it may be.
Yeah, we had a conversation, guys, about growing a channel. Paul and I were actually, conversation / argument / discussion about the idea of like really taking care of the people who followed us, all the great followers we have, and you know who you are, versus the people that come on the live stream and maybe just walk in and start typing in stuff. So we have to have this balance of like getting new subscribers that we love and pleasing the ones that we already have, and you guys are incredible. If you join the Patreon, it's much more funny and uncensored, and we'll do more. Paul, I meant to ask you, are we streaming from Mexico? Because I've been spoiling it, and Don's saying you're hesitant on the Mexico live streams.
No, I said yesterday I was all in favor.
Great. So we will be live streaming from Paul's Mexico houses in January. If all goes well with the COVID and everything and the flying, we'll get that done. And besides that, join the Patreon. The link will be below. And these live streams are redone. So if you missed it, go back and follow it. And you guys are awesome. Thanks for following. Don's playing me off, much like
He has been for a while.
Has he? Oh,
Yeah.
shit. I'm just rambling. I love you guys. Thanks for watching. See you Thursday. Bye, guys.